When Sam Walton died in 1990-2, he left his heirs Walmart stock worth $23 billion, stock he bought for nearly nothing decades earlier. The gain was $23 billion. The capital gains tax owed on that appreciation. Zero, not reduced, not deferred, erased, completely, forever. His children inherited $23 billion in assets, received a stepped-up basis to current market value, and every dollar of gain that accumulated during his lifetime vanished for tax purposes. Death was a tax deletion event. Meanwhile, when your grandmother dies and leaves you her house, the one she bought for $50,000 that's now worth $300,000, you inherit that gain. You will pay tax on it. Maybe not immediately, but eventually. Unless you're wealthy enough to use the same structures the Waltons do, which you're not, because stepped-up basis works perfectly. When you're inheriting billions and barely helps, when you're inheriting thousands, this is the most powerful wealth preservation tool in the American tax code. More valuable than offshore accounts, more effective than carried interest, more permanent than any trust structure, because it doesn't defer taxes, doesn't reduce rates. It eliminates the obligation entirely. 100 years of appreciation, 1,000% gains, 1 billion in growth, all of it, untaxed forever. The moment of death resets the cost basis to current value. The tax liability dies with the person. The wealth transfers clean, pure, untaxed. And this isn't some exotic loophole requiring expensive lawyers. It's automatic, built into the Internal Revenue Code since 1921, Section 1014. Basis of property acquired from a decedent, the stepped-up basis rule, and it cost the government $41 billion annually in lost revenue. $41 billion every year from one provision, benefiting primarily the wealthiest 1% of estates, while you pay tax on everything. Every dollar earned, every gain realized, every inheritance received if you're not wealthy enough to structure it correctly. This investigation analyzes Internal Revenue Code Section 1014, Joint Committee on Taxation Revenue Estimates, and a century of failed attempts to eliminate this loophole. All sources documented in the description below. The stepped-up basis rule was created in 1920. The Revenue Act, America was recovering from World War I. The income tax was relatively new, implemented permanently only in 19... The estate tax existed, but rates were low, and Congress faced a problem. If someone died holding assets, should their heirs pay income tax on the appreciation when they eventually sold? The original owner never paid because they never sold, but the gain existed, accumulated over a lifetime. Should it transfer with the asset? Should heirs inherit both the property and the tax liability embedded in it? Congress decided no, for several reasons that seemed logical at the time. First, tracking original cost basis across generations was difficult in 1921. No computers, no centralized records. If your grandfather bought land in 1894, $100, and you inherited it in 1920-1, how would you prove that cost basis? What if records were lost? What if multiple transactions occurred? The administrative burden seemed impossible. Second, there was an estate tax. Not a large by today's standards, but it existed. Congress reasoned that taxing the transfer at death root estate tax, then taxing the appreciation again through capital gains when heirs sold, was double taxation CM done fair. So they compromised. Estate tax applies at transfer, but the cost basis steps up to date of death value. Heirs start fresh. Any future gains get taxed, but the past forgiven. This made sense for small estates in 19... A farmer dies, leaves land to children. The land appreciated modestly. The estate pays some estate tax. The children get stepped up basis, can sell without capital gains, can keep farming without tax burden. Seemed reasonable. Fair, even. A way to prevent tax complications from destroying family farms or small businesses across generations, and for decades it functioned this way. Estate taxes were high enough to capture significant value at death. The step-up was a simplification mechanism, not a wealth preservation strategy. But then the estate tax weakened, exemptions rose, rates dropped, planning strategies proliferated. by the late 20th century. The estate tax applied to fewer and fewer people. Currently, the exemption is over 30 million per person, over 26 million per married couple, adjusted annually for inflation. 99.9% of estates pay zero estate tax. Zero. They're below the threshold, but they still get stepped-up basis. All of them. The billionaire dies. Estate tax might apply above the exemption, but even then, the assets step up. The appreciation escapes capital gains tax forever. And the truly wealthy discovered something magical. If you never sell, if you borrow against assets instead of realizing gains, if you hold until death, you can access unlimited wealth during life without ever paying capital gains tax. And your heirs inherit everything clean. This is the heart of Be Broad Eye, the Trinity strategy by assets that appreciate, borrow against them to fund lifestyle. Die holding them so basis steps up. Your heirs sell immediately after and pay zero capital gains because their basis is current value. The loans get paid from estate. The wealth transfers. The taxes never come due. Not in your lifetime, not in theirs. Not ever if you're starting to understand that death is a tax avoidance strategy for the wealthy, that dying is actually financially optimal if structured correctly. Then you need to see the scale. Subscribe now, because what comes next reveals exactly how much wealth transfers tax-free every year. How dynasty families use this to stay wealthy forever, and why every attempt to close this loophole has failed spectacularly, repeatedly, permanently. Let's calculate what stepped-up basis actually costs. The Joint Committee on Taxation estimates it reduces federal revenue by approximately $41 billion annually. That's capital gains tax that would be owed on appreciation, but never gets collected because basis steps up at death. $41 billion per year. Over 10 years, that's $410 billion, nearly $500 billion, from one tax code provision. And that number is conservative, based on reported asset values, based on estates that file returns. The true number is likely higher when you account for valuation discounts and unreported assets. Who benefits? Overwhelmingly, the wealthy. The bottom 90% of estates receive minimal benefit from stepped-up basis because they don't have significant appreciated assets. Maybe a house with modest gains, maybe some retirement accounts which don't get step-up anyway. The real benefit accrues to the top 1%. Two people holding stocks that appreciated 1,000% over decades. Real estate that went from millions to hundreds of millions. Art that became priceless. These assets step up completely. The gain disappears. And the larger the estate, the larger the benefit. A $10 million estate might save $1 million in taxes through a $1 billion estate saves $100 million. A $100 billion estate saves $10 billion. The benefit scales exponentially with wealth. The Walton family has used this for decades. Sam Walton died in 1992. His heirs received billions in Walmart stock, stepped up basis. The appreciation from Walmart's founding through his death erased for tax purposes. His children, Alice, Jim, Rob, and the estate of John ... are now worth over $60 billion each. When they die, their heirs will receive stepped-up basis. Another tax deletion event. The wealth compounds across generations. The taxes never come. This is how dynasties work. Not through earning, with step-up, eliminating the tax friction that would otherwise erode wealth transfers. The Mars family, Candy Empire, privately held, multi-generational wealth. Every transfer benefits from stepped-up basis. The Koch family, oil and chemicals. Fred Koch founded the business, died in 1960. His sons inherited, basis stepped up, built the fortune larger. Charles and David became billionaires. David died in 2019. His heirs received stepped-up basis on assets worth over $50 billion. The tax on that appreciation, forgiven the wealth transfer clean. And when Charles dies, ... same thing. Another step-up, another tax deletion. The cycle continues forever. But here's what makes this truly obscene. These families often pay minimal estate tax because they use valuation discounts, family limited partnerships, grantor retained annuity, trusts, techniques that reduce the taxable value of estates below what assets are actually worth. So they avoid estate tax through planning and avoid capital gains through stepped-up basis. The wealth transfer is nearly tax-free. Generation after generation, compounding, growing, never diminishing through taxation, while you inherit your parents' house. Pay estate tax if the estate is large enough. Then pay capital gains when you sell because your holding period starts at inheritance and any appreciation after that is taxable. You're taxed on both ends. They're taxed on neither. And there's a perverse incentive baked into this. It's financially optimal to die holding assets rather than selling them during life. If a billionaire owns stock with enormous unrealized gains, selling triggers capital gains tax at 23.8%, billions in tax. But if they hold until death, the heirs inherit with stepped-up basis. Sell immediately, ... pay zero. The tax savings from dying rather than selling can be billions, literally billions. Death becomes a tax planning strategy, the ultimate deferral mechanism, not until next year, until never, through the grave. Do you see how this breaks the fundamental fairness of taxation? How it creates a permanent aristocracy that can compound wealth infinitely without the friction of taxes? How it ensures that inherited wealth always outpaces earned wealth, because earned income is taxed immediately at up to 37%. Capital gains are taxed at 23.8% when realized, but inherited wealth with stepped-up basis is taxed at zero. Ever, the math guarantees divergence, guarantees dynasty formation, guarantees that the children of the wealthy will stay wealthy, not through merit, not through work, through legal inheritance structures that eliminate taxation at the one moment ... death, when society could recapture some accumulated gain. This didn't go unnoticed. Reformers have tried to eliminate stepped-up basis repeatedly. In 1976, Congress actually did eliminate it, replaced it with carryover basis, meaning heirs would inherit the original owner's cost basis, would pay capital gains on all appreciation when they eventually sold. The law passed, took effect, and was immediately a disaster. Why? Because nobody could prove original basis. If you inherited stock your grandfather bought in 1930... what was his basis? The company might have split multiple times, bond acquired, changed names. Records from 1930 were lost or non-existent. The IRS couldn't administer it. Taxpayers couldn't comply. It was repealed in 1980. Retroactively, stepped-up basis returned. The brief experiment in fairness ended, but the problem remained. By the 2000s, ... wealth inequality was exploding, and stepped-up basis was a major driver. So reformers tried again, different approach. Don't eliminate it, limit it. Cap the amount of gain that can step up, or limit it to primary residences plus a certain amount, or require some minimum inclusion of gain. These proposals emerged from think tanks, from progressive politicians, from economists studying inequality, and they all died. Never got serious consideration, never made it into legislation, because the wealthy lobbied spent millions, funded campaigns, ensured that stepped-up basis stayed untouched permanently. Obama proposed limiting stepped-up basis in his 2016 budget, suggested capping it at $5 million per person in excluded gains. Above that, heirs would pay capital gains tax on appreciation. The proposal went nowhere, didn't even get a hearing. Republicans controlled Congress, wouldn't consider it. But even many Democrats were lukewarm because wealthy donors use stepped-up basis. Both parties have billionaire supporters. Both parties need their money, and touching stepped-up basis threatens that money, so it stays. Biden tried in 2021. His American Families Plan proposed taxing unrealized capital gains at death above $1 million per person, effectively eliminating stepped-up basis for large estates. The tax would be due when someone died holding appreciated assets before transfer to heirs. It was the most serious attempt in decades, had real momentum. Democrats controlled Congress. Biden was pushing hard, framed it as fairness, as ending the unfair advantage of inherited wealth, and it failed. Died during negotiations. Moderate Democrats, particularly Kyrsten Sinema and Joe Manchin, opposed it, wouldn't support the broader bill if it included this provision. So it was removed. Stepped-up basis survived again, like it always does, like it always will, because the people who benefit from it fund the people who could eliminate it. If this has revealed that death is a tax planning opportunity for billionaires while being a tax event for you, if you understand that the system is designed to preserve dynastic wealth across generations, if you see that reform is impossible because money protects money, then you need to know what we're revealing next. Subscribe now, because the next investigation exposes dynasty trusts, how the wealthy create thousand-year trusts that never pay estate tax, how Delaware and South Dakota compete to host these structures, how your grandchildren will still be paying taxes while their grandchildren live tax-free on wealth that should have been recaptured generations ago. The extraction is permanent, the dynasties are forever, and the next episode names the families, with numbers, with structures, with proof. Let's talk about what stepped-up basis means in practice. For a specific example, imagine someone bought Amazon stock in 1997 at the IPO. 1,000 shares at $18, total cost $18,000. Today, those shares ... after splits would be worth over $3 million. If the owner sells, they owe capital gains tax on the gain. 3 million minus 80,000 equals roughly 2.98 million in gain at 23.8%. That's 709,000 in federal tax plus state tax in most places. Total tax bill approaching $900,000. But if the owner dies holding the stock, the heirs inherit with basis stepped up to current value 3 million. If they sell immediately, the gain is 0. 3 million sale price minus 3 million basis equals 0 capital gains. They owe 0 tax. They save $900,000 through death. The government lost $900,000 in revenue from one taxpayer on one asset. Multiply this across millions of estates, across billions in assets, across decades of appreciation. The revenue loss is catastrophic. The wealth preservation is perfect. And this is a modest example. Consider someone who held Berkshire Hathaway stock since the 1960s, or early Apple stock, or Amazon from the beginning, or Microsoft, or Google. The gains are 10,000%, 100,000% on billions of dollars in positions. The tax that would be owed on sale ... hundreds of millions, billions in some cases. All of it ... forgiven by death by stepped-up basis, by a tax code provision from 1921 that was meant to simplify small estate transfers. Now it's the cornerstone of dynastic wealth preservation. But here's the cruelest part. The step-up only helps if you have appreciated assets to step up. If your wealth is in retirement accounts ... For 401k or IRA, there's no step-up. Those are income in respect of A to C. Your heirs pay ordinary income tax when they withdraw, at full rates up to 37% federal. The step-up applies to stocks, real estate, art, collectibles, business interests, the assets the wealthy hold, not retirement accounts, not bank deposits, not the assets regular people accumulate. The benefit is precisely targeted, precisely designed to help those who least need help, while providing nothing to those who most need it. And there's no limit, no cap, no phase out. You can inherit $100 billion with stepped up basis, $1 trillion if such a fortune existed. The provision applies, regardless of estate size, regardless of heir wealth, regardless of any fairness consideration. It's unlimited, perpetual, automatic, the largest single tax break in the code by revenue impact, and it's nearly invisible. Most people don't even know it exists, don't understand how it works, don't realize that death is a taxable event for them, but a tax deletion event for the wealthy. What would happen if stepped-up basis were eliminated? If appreciation were taxed at death, the government would collect $41 billion annually, could fund programs, reduce deficits, lower rates for everyone else. Wealth would still transfer, families would still inherit, they'd just inherit after appropriate taxation. the same taxation that applies when you sell assets during life. There's no economic reason the moment of death should trigger tax forgiveness, no moral justification. It's purely a choice, a policy decision that could be reversed if there were political will, which there isn't, because the people who benefit ensure there won't be an inequality. This creates compounds across generations. A working family saves for retirement, builds wealth slowly, pays taxes on every dollar earned, every gain realized, every inheritance received. Their wealth grows linearly, subject to taxation at every step. Meanwhile, a wealthy family inherits appreciated assets with stepped-up basis, pays no tax on decades of gains, invests the full amount, grows it faster because taxes didn't. Reduce the principal, holds until death, passes to the next generation with another step up. The wealth compounds exponentially tax-free forever. The gap between these families widens every generation. Not because one works harder, not because one is smarter, because one has access to stepped-up basis, the other doesn't. Because the tax code is written to preserve wealth for those who have it, while taxing income for those who don't. This is why wealth dynasties are accelerating. Why? Billionaire wealth is becoming multi-generational. Why the children and grandchildren of today's wealthy will stay wealthy regardless of their own merit or effort. The system is designed for preservation, not opportunity, not mobility, not fairness, preservation of existing hierarchies, existing fortunes, existing power structures, and stepped-up basis is the legal mechanism that makes this possible, that ensures wealth never dissipates, never returns to the commons, never gets recaptured through taxation, just compounds forever across centuries. While you work, earn, pay taxes, save what's left, and hope your children can do the same, knowing they never catch up, can never catch up, because the system isn't designed to let them wake up, see the structure, calculate the gift that death provides to billionaires while taxing you for the crime of dying without billions. A family inherits Walmart stock worth $100 billion, basis steps up. They sell portions to fund lifestyles, pay zero capital gains because their basis is current. The gain that accumulated over 50 years vanishes. $100 billion in appreciation, taxed at 0%. While you inherit your parents' paid-off house worth $400,000, your basis might step up, but you're not wealthy enough to hold it forever. You sell to split with siblings, maybe face some estate tax. The gain that happens after you inherit gets taxed. You pay, they don't. Same law. Different outcomes based purely on scale, on wealth, on access to planning, on whether you can afford to play the game correctly. Stepped-up basis isn't a loophole in the sense of unintended consequence. It's a feature working exactly as designed to preserve wealth, to enable dynasties, to ensure that those born into money stay in money across generations, across centuries, forever. And every attempt to change it fails because those who benefit from it fund those who could change it. The circle is complete, perfect, unbreakable. You're told that America has no aristocracy, no inherited nobility, no permanent upper class, but stepped-up basis creates exactly that, a financial aristocracy that can compound wealth infinitely, that never pays capital gains, that transfers fortunes across generations without the taxation that would naturally erode them. You live in a society with lords and peasants. You just call them billionaire, heirs, and workers. The structure is the same. The outcomes are identical. And the law, specifically Internal Revenue Code Section 1014, ensures it stays this way forever. The stepped-up basis loophole costs $41 billion annually, eliminates taxation on trillions in generational wealth transfers, benefits exclusively the wealthiest 1%, has existed for over a century, survived every reform attempt, and will continue forever. Not because it's economically optimal, not because it's fair, not because it serves any public interest, but because the people who would lose if it closed control the people who could close it through money, through influence, through the system they've designed to protect themselves at your expense. While you pay taxes on everything, they pay on nothing. Through death, through step up, through a tax code that treats mortality as a deletion event for billions in gains, while treating your modest inheritance as taxable income. Same deaths, different tax treatment, based purely on who you were and how much you had when you died.